Hey guys, it's Stephen from HDQ Chartered Accountants, and today I just wanted to cover a few more details regarding the discretionary trust structure for property investment. So by now, we should all be familiar with the advantages. We've all heard them before. Number one, asset protection. Number two, tax minimization. And number three, in certain circumstances, you are able to preserve your individual borrowing capacity. But what about the disadvantages? So, there's no negative gearing under a trust, but does that mean we lose the benefit entirely? No. So, if you had a negatively geared property, you owned it in your individual capacity, we understand that you would be able to offset your individual income with the losses from the investment property. But under a trust, what happens is the losses are trapped within the trust, and they're recorded and carried forward to offset future trust income. So let's say in year one, we had a $10,000 loss. In year two, we had a $10,000 loss. This means that by year three, we have $20,000 of carried forward losses that we can use to offset our net trust income. So let's say in year three, we have a $20,000 profit. That means that we can elect to use the losses in year one and year two to bring our taxable position to zero. What about land tax? So let's say we are a property investor that primarily buys in New South Wales. We understand that the land tax-free threshold under an individual capacity is sitting about $1 million. So that means if we have a piece of land worth about 800K, we will pay 0% in land tax annually. But under a trust structure, there is no land tax-free threshold for these properties that you hold in New South Wales, which could mean a 10K plus bill if you have a $1 million piece of land annually, which could really affect your returns. What about the cost of borrowing? We understand that because we're not borrowing as an individual, but we're borrowing as a trust, our interest expenses could be about 0.5% plus more expensive than buying under the individual capacity. So, knowing these factors, should we still set up a discretionary trust structure for property investment? And the answer is, it depends. What's your goal? What are you trying to achieve? What's the size of the portfolio that you're trying to achieve? What's the time frame that you're going to be investing in? Because if your goal is just to accumulate one property or two investment properties, and you can do so under your individual capacity, and you're having no issues with borrowing capacity and so forth, maybe it's a cheaper option to buy under your individual capacity because you're not aiming for a medium or large portfolio of 5 to 10 properties plus. But for those who want to play the game, grow a huge portfolio, these disadvantages aside, will the trust structure help you in the medium to long term? It definitely will. So I guess the consideration is it worth paying the additional compliance cost? Is it worth paying the additional land tax in certain states? Is it worth paying the additional interest if it can help you push past 2 or 3 investment properties and achieve of a portfolio of 5 to 10 plus? And in what time frame? Because the chances are, if you buy a property today, it will not help your borrowing capacity until you've basically paid off the property. But if you utilize the trust structures correctly, in certain circumstances, let's say if a trust was self-sufficient, that means that it can preserve your borrowing capacity in order for you to continue borrowing and continue purchasing these investment properties.